Okay, good afternoon, and welcome to the webinar, Future Gen webinar we're running this afternoon, which is specifically on corporate bonds. And this afternoon, I'd like to introduce our guest speaker, which is Stephen Mackie, who is from FIIG and is involved in the selection and analysis of actual corporate bonds that we use for our clients in and out each week. Steve, welcome. And I know you've got a presentation this afternoon, but obviously it's a time where we've got share markets at all-time highs. We've got basically cash rates really down in the gutter. Term deposits getting 2.2%. It's probably a good time. People ask the question, how do we get return, but manage risk? And I guess that's what you're talking about today.
Exactly, Murray. So I mean, corporate bonds really sit in that segment that most Australians haven't really had much exposure to. We all love our shares, we love our property. We know, the importance of cash, having cash in the bank and the safety that can provide. But bonds just provide a fourth asset class, really. And when we talk about bonds, we're not really talking about government bonds because the yields on those government bonds are quite low. More often than not, no more than the rate of inflation. So corporate bonds really provide that sort of gap between your term deposits and equity holdings. So not as risky as equities, but pay a bit more than your term deposits. So it's really filling a bit of a segment in most people's portfolios that doesn't exist at the moment.
Yeah. Okay. Well, listen, I'll let you've got a presentation.
Excellent. Yeah. So we'll run through this, Murray. So it's the presentation's entitled "Why Bonds? Why Now?" So what I'm going to run through initially is just give you a bit of a background on the world. We like to start things at the top and work our way down. What's the macroeconomic environment look like? By macroeconomic, we mean, how's the state of the global economy? Drilling down, how's the state of the Aussie economy? What's that background at the moment? Because as an investor, we really want to make sure that we've got a big picture view, and that's how we get that big picture view. And then we can start delving deeper into what sectors we like given that view. We'll have a look at asset allocation. Again, with bonds, that's our meat and potatoes. So I'll kind of focus on bonds and how they fit into a portfolio. We own as investors other asset classes, and we just believe bonds represent something else that you can put in a balanced portfolio. Then, we'll talk about why bonds. So the demographics of the world are changing. Particularly developed economies. People are living longer. We're all getting older. The retirement age creeps up on people before they know it. So, is that super pot that you've got going to pay you enough income? And how do we get that income? We know franked shares obviously provide people with a bit of income, but what else can we look at to give us that regular paycheck? So, that's one of the important things that we'll talk about. The defensive nature as well of bonds. So, as with cash in the bank, that's your ultimate defensive asset. When things go bad, you want liquidity. And we'll talk about, how a bond is similar to a deposit and some of the key differentiators of it. And then finally, diversification. So cliche that we've all heard over the years is, diversification is the only free lunch, et cetera, et cetera. What does that really mean in my portfolio? So we'll touch on that again. Taking a bit of a overall view. Whilst I'm the bond guy, I've got to take a step back and work out how does this fit into clients' portfolios overall at Future Gen. So, what is the macroeconomic background? Where are we sitting at the moment in the Australian economy? Well, I mean, things had been going well here for some time. We had the mining boom up into the GFC. And given the nature of our economy, Australia largely missed the pain that the rest of the world felt during the GFC because of our exposure to mining. But over the past few years, pretty much starting in 2010, we've kind of tracked on a little bit subpar in terms of GDP growth. And the trend has definitely declined as of late. This has been pointed out by the Reserve Bank that, we're going through a bit of a soft spot. Properties come off the boil. Chinese investors have kind of backed away a bit from the main property markets of Sydney and Melbourne. That's been felt around the country. Some of our key exports, for example, coal. If you look at the Newcastle coal price, that's a little bit low. We've seen an uptick recently in iron ore, which is good for Australia. But generally, things are a little bit soft, and housing and the consumer are a key component of the Aussie economy. So the Reserve Bank has good cause to be concerned. So they're not really concerned about where we are now. They're more concerned about where is the economy in 6 to 12 months' time. Because if we get to a point in time where the consumer does not feel confident, it's normally too late for the central bank to act. So they're doing what we call preemptive cuts at the moment. So they've done 2 cuts to the cash rate to bring the overall funding level in the economy down. So that's preemptive. It's a different tactic by the RBA, but they've got 2 reasons for that. So I've mentioned GDP growth. The second reason is inflation. So inflation has been falling around the world for many years, to the point where in many European countries, inflation is either flat or close to negative. So if you're an investor in Switzerland and you put some money in the bank, you actually get negative interest rates. So that's a phenomenon that is occurring all around the world. So as the global nature of the economy, Australia is swept up in that trend.
In fact, you've got to pay the banker now in Europe, don't you?
You do.
So
back to the old days when a bank was built to protect your money. So you paid the banker to hold your money. So in Switzerland, which are the oldest bankers in the world, you pay them to look after your cash. So that's where we're heading now. There's no compensation for an investor for inflation, effectively, Murray. So, as a bond investor, how can I get a little bit more pickup over that bank cash rate, which in Australia, we see heading down to about 0.5%, but I'll touch on that a little bit later. So the overall trend in inflation, and the inflation print came out today at 1.6%. And that's basically the bottom of the RBA's, below the RBA's 2 to 3% band. So, the RBA know that. They're trying to fix the problem. They're trying to get it back up to that 2 to 3% band. So why do we want inflation? Well, inflation's, it's good for companies. It gives companies pricing power. But also, it sort of generates growth within the economy. It means if we enter a period where there's stagnation, that could roll into asset prices, and we see continued falling asset prices, which we don't want. So we want basically preserve growth within the economy, and the availability of credit helps spur inflation. So that kind of gives us an idea of the macroeconomic background. In Australia, we're really experiencing what the rest of the world has experienced for some time. Now, I'll just point out the anomaly here is the US. So in 2016, a gentleman by the name of Mr. Donald Trump beat the pundits and got into the White House. Now, Trump is, for all his faults, is very pro-business. And his policies have been designed at spurring US economic growth, which for the world is a good thing.
And it's worked, hasn't it?
It has worked. It has worked, Murray. And the markets have stood up and taken notice. And they continue to take notice. So Trump has done what's known as fiscal measures. So he's looked at the fiscal side, the government spending side of the US economy. He's reducing the size of the US government. So he's reducing any fat within the US economy. And he's trying to get business to step in and take the place of where US government departments had traditionally worked. Your classic privatization style model. So he's basically put those policies into play. The next thing on Trump's radar is the cash rate. So as far as Trump's concerned, he wants the US cash rate to look like Europe's cash rate, 0 to negative. So he's engaged with the Federal Reserve governor, and they've quickly changed their tune. They were looking at hiking rates in the US only 6 to 12 months ago, and they're now actually looking at cutting rates. So the US Federal Reserve, with the US dollar being the global reserve currency, really dictates what global interest rates are doing. So whilst Australia might have its own problems, America really sets the tone for where the world's going. So this slide, Murray, just really shows you that traditionally in Australia, the RBA, they had 3 jobs. Okay, the stability of the currency of Australia, which again, they're pretty comfortable if the Aussie dollar is somewhere between 60 cents and $1. They've got a pretty broad band with that. They know a lot of the currency is driven by the terms of trade. The maintenance of full employment and the economic prosperity and welfare of the people of Australia. So those last 2 are very important. So they've only got a couple of instruments at their disposal, and the bluntest and most effective of those instruments is interest rates. So as you can see, traditionally Australia had higher rates than America, but we've recently crossed over just last year to have lower interest rates than the US. So we've got economic growth in the radar, in the sights of the RBA, and they're looking at boosting that quicker than the US does. So if you have a look into the future, the path that those interest rates are going, we're looking at cutting our rates down to about 0.75 basis points. And in the US, they're looking at cutting it down as low as 1.5%. So rates are going lower. So those term deposit rates that we traditionally had, experienced 4 or 5%, that was sort of what you expected from the bank. Going forward, we're talking about 1%. Barely covers the rate of inflation at 1.6%. So that gives you a little bit of background, policies in play, both here in the US. We know we're in a bit of a purple patch and they're trying to muddle their way through it. So I'm going to move over to thinking about the individual and your portfolio. So your asset allocation. And as I said at the start of the presentation, we typically have only 2, maybe 3 asset classes in our portfolios, particularly if we manage our money ourselves. And traditionally, when we're starting out in our work career, we're happy with those growth assets. We're happy with shares. We're happy with property. We're not looking at drawing down on the cash that we're putting in our super fund in our portfolio. We're looking at growing our assets. As we sort of enter that transitional phase between work and retirement, we need to start looking at, okay, I've saved all this money. If we had a 30% correction in the market, how would I feel? How would I feel? I've spent 35 years building up my portfolio. I need some protection in here somehow. I want to save the money more than I want the money to grow, because I know at some stage I'll be looking at drawing income, which is an important part. So again, what does fixed income provide? So fixed income provides a third lever in your portfolio. So you've got cash, which, as we discussed, is barely going to cover the rate of inflation going forward. You've got property and you've got shares. Fixed income, and more importantly, corporate bonds, provide investors with that other asset that they can put into their portfolios to provide not only income, but in some cases growth. So if there are bonds that we can buy that are relatively cheap, that we can get at a good price and they can grow in capital value. So what's the history been like? So bonds over the long run generally exhibit lower volatility than shares. So there's an offset for that. Obviously, the return that we get on our bonds is lower. So on this chart, Murray, we're just comparing. We acknowledge that corporate bonds are an income asset and shares are a growth asset. So I'm expecting more from my share portfolio because it's a riskier asset class. It's equity. So this chart just shows the accumulation index of the ASX from March 2000 up into March 2019. And what we see is our share portfolio on an annualized basis has returned about 8.8%.
That's the blue line.
That's the blue line. Yep, exactly. Now, the bond portfolio, which I'll point out is the corporate bond index, so we're not looking at government bonds here, has returned about 6.2%. So we're about 2.6% lower. But the big thing, and this is where a picture tells 1,000 words, is particularly during that GFC period where we saw a big run up in our share values, we didn't experience that decline. In fact, our bonds performed quite well during the GFC period. So again, in 2013, when there was a bit of a decline from the European sovereign debt crisis, our bonds held their value. So it's income, it's steady, and it's coming in, and it's just reducing the overall volatility.
Now look at the difference. It's huge, isn't it? The volatility of equities, particularly given how highly priced they are now.
Exactly.
The volatility starts to increase, doesn't it?
Yep, exactly. And when we show people this slide, I really call it the sleep well at night test. I think I'm going to get more sleep knowing that I've got a bit of money in the green line, as well as in the blue line in the share portfolio. And again, no two investors are the same here, Murray, which is why we don't provide cookie cutter solutions for our clients. Everyone's portfolio is different, and everyone's perception of the market is different as well. So what does that sort of look like? Let's drill down a little bit into these numbers. So if we go on to the next slide, I've broken out the return numbers so we can really have a look at what are we talking about here over this period. So really, if I'm an investor and I'm allocating a unit of risk into the market, I want to know per unit of risk, yeah, we can get greater returns on, speculative stocks. Yes, we can get greater returns on small cap equities, etc. Per unit of risk, i.e. how volatile am I getting paid? So if we have a look at the ASX, as I said before, the annualized return was actually 8.5% over that period. Property, and this is just capital growth in property, was 3.7% annualized. In America, on the S&P 500, 5.6%. So corporate bonds over that period in Australia returned you 6.4% annualized. So we actually did better than putting our money into the US stock market over that period that we've looked at. But the thing that's really important in this slide is the annualized volatility. So how much did that move around? So where we looked at visually, the lines moving all over the place, volatility just measures the disbursement of those returns. So sure, at the ASX, we received 8.5% every year on an annualized basis, but we also experienced 12.4% volatility. So in any given year, we could expect our shares to go up or down by 12.4%. That meant per unit of risk, or what's known as the information ratio, so resulted in 0.7 of a return. So return divided by volatility to give us our information ratio. Now, how's that compare to bonds? So over the same period, we got 6.4% annualized, but our bond portfolio, when we turned up every year, we would only expect our capital to move up or down by 2%. That's a big difference. 12.4% volatility versus 2% volatility, more than 6 times lower volatility, and we're only sacrificing about 2.1% in return per annum.
And I imagine this is looking back, given the market's hitting all-time highs, therefore going forward, the volatility index can only get larger.
It can, yes. It can, and that's a very good point. So there's an index in the US called the VIX index. So it's a good measure of fear in the market. So the moves that it's had recently have been more pronounced. So people, as the market has sort of reached levels that, a lot of economists are saying overvalued. I mean, QIC, Matthew Peters, their economist last week came out and said they see the market overstretched by 10 to 15% in the US. So the corrections potentially could happen quicker than many people give credit to. So that's the thing. So we've built up this growth in our portfolio. We've made some money, but how do we diversify is the point. So it's not about getting out of the growth assets.
Yeah.
It's just about adding in some defensiveness in there. So just so, and we can tilt if we want, or we can just set an allocation and say, I'm happy with X% in corporate bonds because I know if things turn bad in equities or in property, I can look at my corporate bond portfolio, it'll pay me an income, and I know I'll get my capital back at the end of it.
I'll get my money back.
You get your money back, and that's the big thing. So, a bond is designed to pay you back. Think of it as a corporate loan. You're lending your money to a company, they give you a rate of interest, and then at the end, you're the banker. It's a great position to be in. You're lending money to people and getting paid back. So it's the original peer-to-peer lending model.
And these are big companies too.
We're not talking little companies here, Murray. We're talking big companies, anywhere from 100 million up to 500 million, up to billions of dollars in market cap. And we're on top of the equity capital in these companies. So we sit higher up the chain. So that gives me a lot of comfort. I don't mind sacrificing 2% return, knowing that I'm sitting higher up. If something does go wrong, I'm higher in that pecking order than the shareholders. So it's not a bad place to be. So if we have a look at our next slide, let's talk about the product and why are we looking at income product? Because there are a lot of income alternatives out there. So we're not advocates that one asset class is better than the other or bonds are better than hybrids, etc. It's just a general trend that we're seeing globally.
Because every asset class has its season, doesn't it?
It
That's
does.
What you're saying.
It does. Every asset class has its season.
Yeah.
And unless we're getting paid, we're professional fund managers, and we really want to sit there, stare at screens all day, and try and time the asset class. That can be a bit hard. So it's better off just having a few eggs in the different baskets rather than just going in the one asset class. So why are bonds coming to the fore? As I said at the start, the global population's getting older. Australians are getting older. So this chart just basically shows the proportion of Australians over the age of 65 through time. So this is coming from the ABS. So this is the Australian Bureau of Statistics. And this affects everything. This affects how the government spends its money. Where are we building hospitals? Where are we building retirement homes? Planning. Our cities are going to change based on the way it looks going forward. So that's the thing, as people get older, they probably don't need shares as much. You know, their assets are grown, their house has done quite well, but they do need something to replace their income, their salary, or what they drew out of their business at some point in time. So at the moment, about 15% of the population is aged over 65. But, you know, roll forward 20 years, it's almost up to 20%, another 20, 30 from there, and we're up to about 25%. But this is a trend typical in most developed economies around the world. So there's going to be an ongoing demand for fixed income assets. As people retire, they're going to want income, and bonds provide that liquid form of income. So if you have a look about it, I just mentioned, you know, what's the trend? How do we look compared to the rest of the world? So this chart's from the OECD, the Organisation for Economic Cooperation and Development, and it just shows what people's pension accounts look like all around the world. So if you have a look down one end, say Mexico and the Czech Republic, they have quite a high allocation of fixed income in their pension portfolios. The median is about 40%. In those countries, it's around 80 to 75%. But Australia, if you have a look, we are on the low end of developed countries' fixed income allocations at 15%. Now, there's a number of reasons for this, and I'd just like to point out that that has changed in 2 years by 5%. So 2 years ago in 2016, we only had 10% of fixed income in our portfolios. We now have 15. So a couple of reasons. A, Australians typically would buy property. You know, the tax system was set up for property. B, our share market was probably the largest source of capital. But C, and more importantly, the bond market wasn't open to investors. The bond market was typically closed to institutional investors. Retail investors didn't get a look in. You didn't get a look in. If you wanted to buy a retail bond, you bought a QTC government bond at 1.5%. Yeah. What's happened now is companies such as FIIG are opening up the retail bond market. So we've been doing this for 20 years, Murray. So as more investors become aware of what's out there, as more companies start to realise that, hey, we don't need to go to Commonwealth Bank to borrow money. We can borrow money from investors directly through the bond market. That's what we're starting to see. More and more companies are tapping the corporate bond market. And these are big companies. Virgin Australia, they've done 2 big Aussie bonds this year. NextDC, a software data storage company, they've all done public bond issues. And that means that more individual investors can get the sort of returns, and we're talking from 6% up to 8.5% from corporate bonds. So it's interesting to see that, you know, the trend is definitely pushing that way. Do I see us getting towards that 40% median allocation? I think we'll probably end up around, you know, the 30%, similar to Canada, for example, which their economy is quite similar to ours. Mortgage market's quite similar. The economy is structured quite similar. So I think we'd see a doubling of that in the next decade from 15% to 30%.
But I think you're right, Stephen. It's only come about the opportunity to be able to invest directly in the last 3 or 4 years. Before that, we were forced to use, to be frank, managed funds, where we had a lot of government bonds and where your return wasn't great. Plus you had quite large management costs that you had to pay to actually get in. You know,
that's exactly the point.
Whereas,
so that's a good point, Murray, because, you know, when cash rates were 4%, inflation was probably running at 3%, and you were paying a manager 1% to look after the money. Yeah. So really, you probably were better off with the money in cash. The difference with owning a bond yourself, you're not paying a manager for that privilege. Yeah. You're buying the bonds, you take them, you get the coupons every year, and then the good thing about the bonds, you get your money back at the end.
Yeah, and to be frank with you guys, you know, you're the largest provider in Australia. 0 in, no entry fee, no exit fee. 20 basis points is the cost for running the portfolio, which you charge. that's dirt cheap compared to managed funds.
Exactly,
Yeah.
exactly. And the thing is, you can choose what you want to buy.
And you can choose what you want to buy.
Exactly,
Yeah.
exactly. So, you know, like your share portfolio, you determine what's in there. So your bond portfolio should be no different. So we're not doing anything that isn't done in America, that isn't done in England, that isn't done in Europe. This is something that's just going to happen. Like it will get bigger and bigger and bigger. People will get more comfortable with bonds. Interest rates are quite low at the moment. They may not be low forever. You know, if the RBA do their job, inflation will pick up, rates will go back up. But our bond portfolios, you know, it'll just provide more opportunities to invest at higher yields. So, you know, that's the thing. It's a defensive allocation. So the share market can't rise forever. We know that. Newton's law of gravity. Every single person that I run into, and we do a lot of work with stockbrokers, fund managers, you name it, they're all scratching their heads at the moment because it seems to be defying gravity. So, you know, that's the thing. It's not time to reevaluate your portfolio when the share market's falling. You should be doing it now. You should be looking at, okay, how do I defensively position now, but still comfortably get a return? You know, so, you know, many investors will take cash out of the market and then put it into cash, put it in term deposit with the banks. Now, the banks, I wouldn't call it racket, but effectively they've been borrowing off you at pretty much close to the inflation rate and lending out to corporate Australia at great rates of interest, you know, 8, 9, 10%. If you run your own business, you know what those rates are. So
15%, that's right.
They're pretty high.
Overdraft rates.
They're pretty high. So what we do is we provide that same mechanism where investors can invest directly with a company, get a similar return that a bank is getting, and choose which companies they want to invest in as well. So, you know, you can spread out your investment in a range of companies instead of putting all your cash in one bank account. So, you know, there are differences. You know, banks, a term deposit, you don't actually get any income on a term deposit. You get your money back and your interest at the end. So
now, Steve, can I ask you a question about market failure? In the history of corporate bonds in Australia, there's been, I believe, 2 failures.
Yep. So Babcock and Brown, that was
during the global financial crisis.
During the GFC. MFS as well had a bond that was, you know, it was a more structured product. And Pasminco.
Yeah.
So the MFS was more of a structured product, but in terms of actual bonds, Pasminco and Babcock and Brown. So even bonds such as Lehman Brothers, you know, their senior notes, the bondholders got money back, some money back. But yeah, there has been very few, if any, bond defaults in Australia. So the bond market, in difference to the share market, it's like a loan. You know, think of our mortgages, Murray. So if we default on our mortgage in Australia, the bank will follow you. You've got to declare yourself bankrupt for that bank to not come after you, and it will affect your credit rating. A company and a company director is exactly the same. So if you default in the bond market, you cannot borrow going forward. So to repay your bond and repay your coupons is very important. And also, let's just touch on the word default. A bond can default if they don't pay their interest. So, you know, if a bond doesn't pay you your interest, then as a bondholder, you can technically take the company to court in breach of the covenants of the bond. So it's not a share. You're sitting well up the corporate structure, capital structure of the company. You have a lot more protections than a shareholder. So, but, you know, a lot of people will come to us from their term deposits and say, look, I've just looked at the rollover rate, and we're getting a lot of phone calls at the moment. I'm not happy with this. So what can you do for me? So, you know, key differences here. Bonds pay you regular interest. So yes, you get your money back at the maturity of the bond, but over the life of that bond, it pays you regular interest. You can also compound the interest. So when you get paid an interest check, you can buy another bond with it. So, you know, by virtue of compounding, if you're compounding at 6% as opposed to 1.5%, over the course of a period of time in your portfolio, you can get outsized returns. Bonds are tradable. So a term deposit, it's normally between you and the bank. You can't sell it on. If you want to break it, the bank will normally charge you penalty interest. If you want to get out of your bonds, they're as easy to get into them. Just like a share, call your broker and you sell your bonds. When the bond matures, you get your cash back. If you want to buy some more, jump on the phone to your broker and you buy some more. So they're a liquid tradable instrument. In fact, Murray, the bond market is bigger than the share market globally by a factor of about 40%. So the global bond market is 100 trillion and the global share market is about 70 trillion. So it's a big market, and well supported. There's a lot of banks, there's a lot of players in the market. And again, bonds can provide a hedge against inflation. So a lot of people worry about, well, if I buy this bond and interest rates go up, what happens? Okay, there are bonds that you can buy that are known as floating rate bonds, that as the rate of inflation goes up or as interest rates go up, the RBA puts their cash rate up, you get paid more. So really depending on, and we'll go right back to the start of the presentation, our macroeconomic view, that's going to determine how we position ourselves in relation to those products. So it's, again, cash is good. Cash is king in a real crisis, but cash is not really going to pay you anything. You're just going to it'll protect your holding, but for many people, they still need to earn something. So what I've got here, Murray, is just an example of a typical bond portfolio at FIIG. And it's a real mix of different companies, from low risk investment grade companies such as AAI Insurance. We've got a bond in there from Sydney Airport. That's an inflation linked bond. To other names that people will have heard of, Virgin Australia, Zip Money. And again, these companies, because they're unrated, they're what's known as high yield bonds. So they don't carry what's known as an investment grade rating, but FIIG will assess all of these companies on their credit worthiness before they issue a bond. So Virgin Australia, they've been very popular with investors. They initially issued that bond last year at about 8.25%, and the bond's gone up in value and done quite well for our investors. Sydney Airport, for example, it's a monopoly. Yeah. So, we like assets that are monopoly assets. We like infrastructure. We like railway providers. We like businesses that are paying steady, predictable cash flows and are key critical assets. So the insurance industry, for example, AAI, the barriers to entry to insurance are quite high. So, to get into that grade of insurance, sort of the top end of town, it takes a lot of work to get in there. There's a lot of regulatory hurdles that you've got to do. And that's why we like these sort of companies. But, what's the return look like? For a typical portfolio, we're looking around the 5% mark. Okay, so let's look at that relative to where cash is at the moment. So cash, we can get around 1.5%.
2.2 in term deposits.
2.2 in a term deposit. So for our corporate bond portfolio, we're getting about 2.73% over the term deposit rate. So if I were to go back in time and have a look at the S&P 500 over, say, a 50, 100-year period, what's known as the equity risk premium is around about 3 to 3.5%. So we're getting paid a return that's quite similar to an equity risk in a bond portfolio.
Yeah.
So.
Yeah, I can't see how you'd be paid that equity risk portfolio in Australian equities right now.
Yeah,
the price.
Exactly. Going forward, do we think that the return in Aussie equities is going to be greater,
or US equities, don't matter,
from this point in time than 5%? If the answer is no, then it is time to look at alternatives.
Yeah.
So, but the timing, it is hard to pick a top. Markets can be irrational longer than you can be solvent. We know the cliches. And the dot-com period was exactly the same. So we don't know. Central banks can keep pumping in stimulus. Risk assets can do quite well. But as bond investors, we're just looking for something else. What else is out there that we can put our money into and take some profits as the market rises?
Because the longer the stimuluses go on and the longer the market keeps on climbing, the greater the risk.
Exactly. Yeah, so. Exactly. So, and just finally, Mary, this slide just shows you those bonds that we had. And where the cash flows fall. So, for many investors, they might be retirees. They're just looking for a steady paycheck. And this is what a bond portfolio gives you. It gives you different sources of income. which is what we're looking for. So different companies, different times, different types of coupon, but just overall, it's paying you regular cash flows that you can either spend or reinvest depending on your circumstances.
Excellent. Well, Steve, I'll just check if there's any questions. Roy, are there any questions in the chat box from visitors to our webinar this afternoon?
We don't have any question yet.
No questions? Okay. We're happy to take questions at this stage. Greg, any questions?
How do they work out the rate of return? So the company?
The company? Okay. Yeah, so depending on the creditworthiness of the company. So, just as going from mortgage, some borrowers can get a mortgage at the moment at 3%, some have to pay 5%. So it'll depend on the credit history of the company, depend on the sector that they're in, what their revenue looks like. Also, what's their balance sheet look like? Some companies will issue a bond and they've got a lot of cash sitting on their balance sheet. NextDC is a good case in point there. They issue bonds and they pay about, kind of 3% over the bank deposit rate. So it's really, the more riskier company, say for example, Virgin, when they issued last year, they paid 8.25%. So airlines are typically fairly risky. They've got exposure to fuel, tourism, etc. So they paid a lot, and at the time, Virgin was seen as being relatively leveraged, and leverage is important. The new CEO of Virgin, Paul Scarra, he's worked to reduce down that leverage. So Virgin's borrowing cost has gone from 8.25% down to about 7.25% this year. It's a lot. So yeah, there's a number of factors, and they change all the time. Some companies get better, some companies get worse.
Yeah.
And
that's why City Airport Corporation is a low risk asset.
It's a low risk asset. It does pay a lower rate of return, but I know in the 12 years when that bond matures, that Sydney Airport's still going to be there. There's only one of them. Even if Badgerys Creek is up and running, that's still going to be the preferred airport. It's a very expensive piece of real estate.
Whereas Adani Abbott terminal up in North Queensland, which exports coal, pays quite a significant yield, doesn't it? Around 7%.
It does. Yeah. It does. And again, there's a number of factors there. Adani itself, as a borrower, obviously a lot of headline risk there. A lot of people didn't want to lend to it, so they had to pay up for their funding. And let's keep in mind that bond is just funding the terminal, the port terminal, not the mine. And that asset was sold to Adani by the Queensland government. So you're owning a bond that the Queensland government owned, not sort of 5-10 years ago. It's paying you 7%. So even without the Carmichael mine, coal will still pass through that terminal. So, and again, it's one of those things for investors that they've got to determine for their own portfolio. Some people don't like owning fossil fuel investments. And that's the beauty of having a solution where you can determine what goes in your portfolio as well.
Yeah. Thanks, Steve. Just to clients who are listening out there, obviously we will post this online. Roy will do that in the next 24 hours, so you'll be able to listen back on it. But if you've got any questions in the meantime, please send them through. Once again, this is I've got to give you the official line. This is a general advice presentation. Please don't act on this unless you actually get advice on your particular circumstances. But thanks for attending this afternoon. Thanks, Steve.
Thanks, Murray.